Hello everyone, welcome to our session today. Today's session is focused on maximizing your wealth, especially when your marginal tax rate is very high. Yeah, this is mainly because recently we got a couple of new clients and some like because they didn't know how to or different ways to maximize their wealth, and then their wealth is actually shrinking. So I thought it's necessary to pass this knowledge to everyone. Okay, at least you are aware of the issues here. All right. Before we go to the main content of the recording of the session, a quick declaration. The information provided is for general guidance only and should not be considered as personalized tax advice. We recommend consulting a qualified tax advisor or planner before implementing any tax planning strategies. Please note that we're not licensed financial planners and do not provide financial product advice. For tailored investment guidance, consult a licensed financial planner. Right. Okay, so basically the basic rules, if you want to maximize your wealth in Australia, okay, there are two things that's really important. One is smart investment. So basically you need to focus on long-term growth, diversification, and inflation protection. So look at your risk tolerance and then try to find the best investment product to maximize your return. All right. That's on the investment side. All right. The second thing you have to consider is strategic tax planning. So of course here is to reduce tax and then maximize after-tax returns through the right structures and timing. Okay, so what really matters after you combine the two things together, your after-tax return, because that's the only thing that will go back to your own pocket. All right. So when you single out the two factors, neither of them will be able to maximize your wealth because sometimes people they just want to minimize their tax. How do I reduce my tax? If your income is low, your tax will be low. Yeah, that's not the answer. And then sometimes people ask, yeah, if I have the best product, investment product, would that help to maximize my wealth? That's only part of the answer. If you actually get the best investment product achieving 13.5%, say for an example, if you have to pay 47%, your wealth or your return will be halved. Okay, nearly halved. And then that's actually below average market return at the moment. Okay, so basically, important is not just what you earn, it's what you keep that grows your wealth. All right. Okay, then let's have a look at an example just to illustrate the point. Let's say someone have 300K in a term deposit and earning 4.5 interest every year. And under an average inflation of 3.5, this would result in a real value of only 269K after 10 years. Okay, so this is because when you are factoring in 4.47% tax, okay, after tax return on the term deposit is only about, say, 2.2, 2.3%. When the inflation rate is 3.5% every year, then the purchasing power of that 300K, of course, is going to reduce every year. So when we convert the dollar value to today's money, that's actually equivalent to today's purchasing power. That's only 269K. So that's actually shrinking in 10 years' time. Okay, in contrast, 300K you invested with a 10% annual return combined with smart tax planning strategies could grow to an inflation adjusted value of about 551K over the same period, over the 10 years. Okay, that's because on the 10% annual return, we can find smart strategies to reduce it to the minimum, sometimes even to 0%, no tax at all. So you can keep all the return in your pocket or reinvest that for the future. That's how we can manage to increase 300K to 551K, okay, over 10 years. All right. So with efficient investment choices and advanced tax planning, your wealth could effectively double in 10 years. Okay, even after accounting for inflation. Okay. All right, here is a chart I have prepared. So in this chart, okay, the top one, of course, is when you receive 10% return and also adopt really smart, advanced tax planning strategies. And then you can see your wealth will definitely grow, okay, very quickly. And then the bottom line is actually when you have a term deposit, receiving 4.5%, paying 47% tax. All right. Okay. And then the middle one actually added one more. It could be relevant for some people as well. That's actually put your money in term in like to offset your mortgage. Maybe your mortgage rate could be 5.5%. But the issue is when you're doing that, there will be no tax impact, or basically you can't claim any deduction on the interest. And then so basically, of course, your net return will be 5.5%. That's your interest rate. And then when you factor in the inflation, it's still going to be slightly better than when you earn an interest income you compare to the term deposit. Yeah, when there's no tax impact, the pure tax saving to you will be the interest you have saved on your mortgage, on your loan. Okay, that's 5.5% if that's a low interest rate. Then there's no tax impact. Then that's actually beating inflation rate as well. So that's why it's still increasing slightly. All right. So that's everything I wanted to mention, just to give you a very easy to understand example. But in real case scenario, there are many other strategies you can consider. Yeah, you can consider including your investment in a trust structure, potentially self-managed super fund. Also, retirement planning strategies could be included depending on your age. So there are a lot of other strategies or factors you could consider. All right. Okay, here is a brief introduction about myself, all my qualifications, and also our contact details. If you have any questions, please feel free to drop us an email or give us a call. All right, thank you. That's everyone for today's session. Thank you for joining us.